All right, today I'm going to show you how the wealthy structure their money to pay less in taxes, protect their assets, and build generational wealth. And here's the thing, you don't have to be a billionaire or even a millionaire to set this up. So stick with me, because once you see how this works, you're never going to look at your money the same way. My name is Fitzpatrick, and I've been helping entrepreneurs and business owners pay less taxes and build generational wealth for over 35 years. And every single time I get on a call with them, they always tell me that they feel like they're paying too much in taxes. Here's the thing. Most people think forming an LLC automatically saves them money. It doesn't. In fact, if done wrong, it can cost you more. So let's break down what the LLC does for you and what it doesn't. An LLC is just a legal box where you put business or investments inside. At its core, it does three main things. First, it separates you from your business. So if the business gets sued, your personal assets, such as house or savings, are harder to touch. Number two, it gives you flexibility on how you get taxed. You can choose to stay a pass-through entity or single-member LLC. In some cases, you may want to choose to be a partnership LLC. An LLC taxes an S Corp, or LLC taxes a C Corp. And three, in certain states, it adds a layer of privacy to keep your name off public records. But here's what it doesn't do. It doesn't make your taxes disappear. It doesn't guarantee total protection if you don't follow the rules, like breaking the veil of protection. And it doesn't automatically make you rich just because you filed some paperwork with the state. The real power isn't just forming an LLC, it's how you use it. And it's where most people either get it right or make an expensive mistake. So if the real power is how you use it, what exactly does it look like? Well, let's show you. I want you to think about this as a map. A map where there are three main boxes you need to connect if you want to protect what you've built and pay less in taxes. My team and I call this the asset map. My friend Mark Kohler might call it a trifecta. And once the client sees this done for them, they get that aha moment where they understand what exactly they need to create themselves for more wealth. Here's how it works. All right, so as we were talking about, we really have three buckets. So I'm going to start here at the bottom with basically where my 1040 lives and my revocable living trust. So that's the core of our foundation. On top here, we're going to split between two sides. We're going to have our operations on one side, and we're going to have our assets on the other side. So operations, so let's say, for example, if my wife and I both are W-2 earners, and then I create my side hustle. So my side hustle is outside of my regular day job. And let's say on the asset side, I have my day job 401k. My wife has her 401k. So that's basically these two. But I start this side hustle, and that could be anything. And that's going to create a lot of additional tax planning, income planning, deductions, so forth. So the side hustle, maybe I start out as a single member LLC, and I create that entity, which also is going to give me the ability to max fund the rest of the 401k that I'm not doing on a pre-tax basis through my W-2 for my day job or my employer match. So I still have room to make let's call it the SH 401k, which is going to be separate from my wife and my 401k here. So this side hustle, as it continues to grow, I may want to consider having it move from a single member LLC to an LLC tax as an S election, so I can basically minimize what's called SE, or my self-employment tax, which is 15.3%. So where I can basically make this S election, that could save me a significant amount of self-employment tax, because I'm going to basically pay myself a reasonable wage. So let's say if I'm grossing $100,000 or netting $100,000, maybe for my industry, appropriate wage would be 40% or 40K, which means I'm going to take a K1 distribution of 60K. I'm only going to pay W-2 self-employment tax on the 40, not on my K1 distribution. If we look at this center line, this is really the veil of protection between operations and assets. Because over here on the asset side, maybe I want to invest in a short-term rental property, or I'm going to invest in real estate, and each of these may have its own LLC as well. So I have that veil of protection if someone slipped or fall, that it's not going to affect my other assets. It'll be limited to those investments. All of this is going to flow down to my revocable trust, and the same thing with my net operation. So everything flows to my 1040, and I can continue growing my assets here. So maybe I have a self-directed Roth account, maybe I have IRAs, maybe I have HSAs, as we've talked about. Maybe I have my kids on payroll if they're eligible, and I can have my kids' Roth. So all of this is protected with the separation between operations versus assets, and how and where I title them is very important. But everything flows down to my trust. So I have my operations, I have my assets, and then I have my revocable trust. Setting this up by yourself isn't as easy as asking ChatGPT to do it for you. You need a team who knows your situation with years of experience better than some AI model. That's where my team and I here at Asset Strategy can come in. We will create your very own asset map that perfectly aligns with your situation, that shows you how to put more money in your pocket for generations to come. If you want to get started, you're welcome to book a 15-minute discovery call with us using the link below. It's completely free, and all we'll do is have a conversation to see if we're a good fit together. Thanks for watching. We'll see you next time.